It was a tough day for Wall Street. We didn't see too much selling in the S&P 500, but certain areas like the Russell 2000 really got hit. Small caps were down over 3% here today. So we'll take a look at that information, see what it means for our posture, where we did have a couple of posture shifts that we're going to want to identify. And then we'll get into our trade application example, where I wanted to focus on an area of the market that has been struggling on a relative basis to show you how to do a bearish trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 23rd, 2021. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, and then go down to the description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. Also, I should mention that overnight here, we now have a new Twitter handle for our corporate account. It's just at Market Scholars. There used to be a underscore in there, but we've got that resolved here recently. That's not going to affect most of you because if you're already following us, you would have followed over with that transition. But just pointing that out in case you guys ever tag us on Twitter, be aware that we no longer have an underscore in our corporate Twitter handle. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's charts. And as you can see, we're starting off with chart 4B here, which will show us all four of our major U.S. equity indices side by side by side. And that way we can kind of get a sense if there's any differences that we need to be aware of. And today is actually a pretty good day for that conversation. As mentioned in the intro, the S&P 500 was only down 0.76% today. So that's why we're not starting with that other chart that sometimes I start with when we're down more than 1% or up more than 1%. We were down less than 1% in the case of the S&P 500. However, if you start directing your attention towards the bottom portion of my charts, you'll see things are a little bit different there. The Nasdaq was down over 1%. It was down 1.12%. That's the Nasdaq composite. And then the Russell 2000 was the one that was really gruesome. Russell 2000 was down 3.58% here today. So pretty tough sledding for a lot of those small caps there. This is a market that does seem to be taking the safer route, not necessarily going into treasuries in a big way or anything like that, but in terms of the money that is going into the stock market, it feels like the market is trying to transition towards some of the safer areas. Some of you might have seen me joking on Twitter earlier today with the dividend aristocrats yawning. Today, there, stocks like Coca-Cola were up, right? Coke was up 0.76% today. Walmart was up over 1% today. Pepsi was up over 1% today. Kimberly-Clark was up over 1% today. Procter & Gamble was up nearly 2% today. Colgate was up over 2% today. Clorox was up nearly 2%. So you get the point there. Those are all very well-known dividend aristocrat companies, typically coming from a very boring portion of the economy, usually consumer staples, where you don't have as much variability in the business model. And so that seems to be the types of stocks that have gathered a little bit of steam here recently. Meanwhile, many of the high-flying growth and momentum stocks out there are really struggling, and certainly feeling the effects of that in the various classes that I teach as well. My top-down trend trading class that had done so well in 2020 has been struggling a little bit here more recently, as we've kind of had to run into a little bit more of a challenge than we were used to. Meanwhile, my dividend growth investing class that I taught earlier today is just firing along on all cylinders. So, it really depends on where you're hanging out in the market. There'll never be a perfect way, but right now it does kind of feel like the market's hunkering down in some of those safer areas and wants to kind of leave the riskier stocks for another time. You'll see here that the Dow Jones was down today as well, but it was down less than 1%. So you've got kind of your two big cap indices up here at the top, and they retain their bullish intermediate posture according to the market forecast. So again, the background colors of chart 4B will determine whether we have a bullish or bearish posture using that market forecast green line. Remember, when the green line is in the upper reversal zone of the market forecast technical indicator, then that means the intermediate posture is still strongly bullish. On the other hand, down below here, you'll see that the Nasdaq Composite and the Russell 2000 after today's sell-off now have pink background colors. And the reasons for that is we now have a green line in the market forecast technical indicator that's rolling over. Notice for the Russell 2000, we fell out of the upper reversal zone. And with the Nasdaq, that one had already been kind of struggling on a relative basis. So while it never made it back into the upper reversal zone, it has already reversed lower once again. Remember, it's been a week since I've been with you. On Thursday, I took that day off, and thank you for that opportunity. I always like to take a couple of days off during the opening weekend of March Madness. It was nice to be able to kind of gorge on college basketball all weekend. But anyway, when I was with you a week ago on Tuesday, I was mentioning that the Nasdaq was kind of the problem child. And I've been mentioning this for a few weeks, so this is not something that's completely new. But point is, this is the chart that continues to concern me. You can see here that the Nasdaq chart is different than the rest of the charts. The Nasdaq chart really started struggling back here kind of in mid to late February, and notice that the Nasdaq got a red moving average basically the first, or actually it was the third day of March. So March 3rd, we had that red moving average combined with that dark red background color. That's telling us that we have a strongly bearish posture using the market forecast technical indicator, and the stock was then, or in this case the index, was then trading below its falling 30-day moving average. So that was pretty early on. We saw a little bit of that up here with the S&P 500, but it was able to resolve those worries by going up and through that moving average so easily and actually hitting a new all-time high. Notice the difference between that with the S&P 500 and down below with the Nasdaq Composite. Yes, we had this reversion to the mean type of a move, and remember, we were expecting that. What we were looking for was what would happen once it got to the 30-day moving average. It did not act the same way that the S&P 500 did. This cut was so deep in the Nasdaq Composite that when you had your reversion to the mean move, it gave you all that it could muster just to get up to the moving average. And as is so often the case, the moving average starts to act as resistance, no longer support. Remember, back here for the Nasdaq Composite on January 29th, we were in an uptrend. At that point, we had a kind of a 4 or 5 day sell-off there, but we weren't overly concerned. We were still trading above the moving average, and indeed it kissed it, bounced right off of it, kept on heading higher. Everything started changing right around here. Then it gave us a reason to worry, and we remain in that worrying category. As it stands, basically since the middle of February, we've spent nearly the entire time below the 30-day moving average. And it just seems like it doesn't have the energy to get up and establish a higher zone there. Remember, the Nasdaq Composite was the superstar of 2020. That's where all of your high momentum, high tech, high growth oriented names were. But that has really cooled off in a big way, where we've seen more traditional stocks, maybe more blue chips like those that I mentioned before, your Pepsis and boring companies like that, doing a little bit better on a relative basis. And so anyway, it didn't really help my concern here today at all when we saw the Nasdaq fall another 1%, and it still is giving me the impression that it does not want to establish any trading range above that moving average. And keep in mind there will be folks that will come out here and suggest that the sell in May and go away mantra will be in effect. Before we get to May, however, remember that April is traditionally a better month for the stock market. So who knows? Maybe we'll get a little bit of choppiness before then. But if the market's looking for an excuse to sell off stocks, maybe it'll use that sell in May and go away. And right now, out of these 4 charts we have in front of us, I would say that it's the Nasdaq that is the clear laggard to me, and it's probably the one that I least want to be a laggard. In other words, you tend to have a lot of risk-taking appetite when the Nasdaq is leading, and right now it just is not kind of going along with the flow. And that is a little bit concerning for risk-taking appetite in general for even some of the other areas of the market. So we'll keep our eyes on that, but I wish I had better news for you, but that's our pain point right there in the Nasdaq. I should also point out that we do have what's known as a bullish intermediate confirmation signal on the S&P 500 and on the Dow Jones Industrial Average. However, we tend to use that blue line to try to help us establish if they're a more ideal setup or a less ideal setup. We have a more ideal setup here with the S&P 500 where that blue line is between 20 and 50, but with the Dow Jones, it's a less ideal setup with the blue line kind of falling a little bit too far. It's actually in the lower reversal zone as well. And just to catch everybody up to speed, I know we go through this plenty of times, but we always get new YouTube viewers, and hello to all of you that are new. But a bullish intermediate confirmation signal is effectively just looking for the green line with a bullish posture. And remember, the green line can be bullish in two different ways. It can either simply be in the upper reversal zone, like is the case right now for both the Dow Jones and the S&P 500, or the green line could be traveling higher between 20 and 50, like it was kind of back here on the Dow Jones in early February. So that would also be considered bullish. So once you've identified that you have a bullish intermediate posture, then the second piece of that to determine whether you have a bullish intermediate confirmation signal is if the red line, the momentum line, is in the lower reversal zone. There it can't just simply be traveling lower between 80 and 20. It actually does need to be in the lower reversal zone. And you'll notice that today the S&P 500's red momentum line basically fell here to about 10.87. Remember, you can read those in the label right there. And then with the Dow Jones, it fell down here to 7.67. Both of those being below 20 means that they were in the low reversal zone. So we'll see if that means anything for the market going forward. I would say that it is still a good sign that both of them are above rising moving averages. But again, I'm not going to necessarily assume that it's smooth sailing here. Usually you want all of these kind of markets to be in unison with one another. And right now you've got enough breakdown activity with the Nasdaq Composite and the Russell 2000 where it's starting to become a little bit more worrisome even for those bigger areas of the market with those large cap companies. All right, let's take a look at our three green arrows set up here, and this will be chart 4D. All right, so as this pulls up here, a reminder, the background colors on this particular chart will tell us whether we have a 3 green arrow setup or a 3 red arrow setup using a daily candle chart. As we're looking at the S&P 500, you see the background color is still that light green, telling us that we do indeed have a 3 green arrows set up at this moment in time. That could disappear as soon as tomorrow under the wrong types of circumstances. In other words, remember that we are basically right on the brink of going to a red arrow on the moving average, the MACD histogram, and the stochastic. So any one of those could really go wrong. The MACD histogram appears to be the one that's closest to possibly going to a red arrow status. It's basically sitting right on that zero line right there. Remember, the MACD histogram is trying to measure how much momentum the market, or in this case, this index currently has. And so it does still have bullish momentum, and that makes sense. We're still in an uptrend on the S&P 500, but this rolling over effect that you see right here is telling you that the positive momentum is kind of waning, and you'd rather see it accelerating, kind of like you see back here when those bars were kind of green. But right now, the wind is kind of coming out of the sails just a little bit there. So don't be surprised at all if tomorrow we get a red arrow on the S&P 500's MACD histogram. Russell 2000 is already at a 3 red arrow signal. That happened today with the big whoosh lower. Again, that was a 3.58% move lower. That's a pretty significant drop there for the small caps. And you'll notice that that was enough to push us below the moving average, also enough to put in a red arrow on the stochastics, which is measuring where the stock is trading within recent trading ranges. And if you're trading near the low end of those ranges, you typically are going to have a better chance to get a red arrow, as we did right here. So the Russell 2000 is a bit of a challenge at this point for trend traders. Let's go ahead and pop on over here to the internet briefly. I always like to get an opportunity to say thank you to those of you that help support this product. Last time around when I did it on Tuesday, 118 of you came out of the woodwork. I really appreciate you. We do notice it, so sometimes it makes you wonder probably if you're clicking like, are we even noticing? We are. We see each and every one of you that come through for us there and help us along with that endeavor. Remember, these videos are promotional in nature. In other words, we do them on a volunteer basis. They're free for everybody, anybody who can access YouTube anyway, and so we need justification in order to take the time out of our day to do them. One way to keep the pressure on us to keep doing these videos as often as possible is by keeping on clicking like. If we know that we're going to be disappointing a whole bunch of you that love these videos, then we're of course going to be naturally more motivated to do the videos. On the other hand, if people are like, yeah, whatever, we take it or leave it. If you're not going to be active on that front, then you can imagine that we can find other things to do with our time as well. But you guys have done a great job for us. Can't complain on that front. Keep it up. We really do appreciate it. From the premium market scholars perspective, I did teach my dividend growth investing class earlier today, and we covered the healthcare space. And so if you're interested in a direct matchup in the healthcare sector, where we kind of do not just technical analysis, but actually a deeper dive on fundamental analysis and business model analysis. Remember, those of you that are premium members, you can access that up here in the Trading Rooms tab. David taught his directional options strategies class, so make sure you're checking that recording out as well. And then tomorrow, what we have on tap is I've got my factor-based swing trading first thing in the morning at 11 a.m. Eastern Time, and that's actually a good segue into what I also wanted to bring up for you here now, which I was just going through some of my factor analysis here before this YouTube video, and in preparation for tomorrow's class. So this is a little bit of a sneak peek of some of the things we'll talk about tomorrow morning. But we are seeing a lot of change that's taking place from a factor perspective. One of the big things we've been waiting on in that class for the last 3 or 4 weeks was for momentum to finally break down to the last position, and we finally found it here this week. It was basically kind of vying neck and neck for that for several weeks, but there's been enough push lower with those high momentum growth stocks that we now see momentum on an overall basis taking the last place position. In the first place position in the overall ranks is once again value. Now remember, that's been the case for the last 3 or 4 weeks, so that's not a surprise. One thing to be aware of that is a little bit of a surprise is dividend yield is all of a sudden making a move. Dividend yield supplanted low size in the number 3 category. And you can see actually the best performing factor fund that we cover over the last month is actually a dividend yield one that comes from BlackRock, DVY, is up about 5% over that time period. Meanwhile, at the bottom of the rankings, you see a lot of that green color where you see the momentum category. In this case, the BlackRock Momentum ETF is actually down 5% over the last month. So we have a wide variety of performances here over the last month. You know, there will be periods where sometimes markets kind of drift in the same direction from a factor perspective. But right now we're seeing some pretty big discrepancies where we're seeing money moving towards kind of the old school types of investments. Your dividend stocks, your value stocks, and your low volatility stocks are starting to come to life a little bit. Meanwhile, it's kind of kicking some of the more exciting but more speculative areas to the downside, things like low size stocks and also momentum stocks. So again, we'll have that conversation more in depth tomorrow morning for those of you that are premium and plus members of Market Scholars, but just wanted to give you a quick little sneak peek there. Back on over here now to our Thinkorswim charts. Let's go ahead and pull up the momentum chart view here. Give me a second to find that. It is this one. Wanted to bring up chart 3D here for you. I wanted to show you momentum is really struggling on a 1-month basis when you're kind of combining all that evidence together. Notice that this kind of area that I'm highlighting or circling with my mouse here shows that momentum, the way that we kind of view it when we're blending all of those momentum ETFs together, is down about 3.5% over the last month. Now, in comparison, you're going to notice something like value that's actually up 3.5%. So this is, sometimes you'll hear people say whether you're in a stock picker's market or not. In other words, can you find alpha within the market by selecting the right stocks rather than some markets where you could just throw a dart and everything kind of goes up and down together. So right now is one of those seeking alpha types of moments where it is a stock picker's market and you're finding a little bit better opportunities in things like value, which is up 3.5% over the last month, dividend yield, which is up about 3% over the last month, low volatility, which is up 1.5% over the last month, and then quality's hanging in there, up 0.8% over the last month. But the two areas where you're really struggling if your exposure is dedicated to those areas are the low size factor, down 1% over the last month, and then the big whammy there, as I mentioned before, momentum really struggling 3.5% to the downside. Notice as well that momentum and low size are the only two out of these 6 factors that are trading below their 30-day moving averages right now. So a lot of stress in those areas, and remember, they were home run areas in 2020. Momentum for pretty much the full year of 2020. Low size really picked up steam near the second half of 2020. But we're seeing a little bit of shift taking place in the market right now. All right, let's go ahead and take a look at some 12 grid analysis now. We'll start with chart 5A. This is our asset class 12 grid. A reminder that the background colors of these charts will tell us whether we have a bullish or a bearish posture using the market forecast intermediate term line. And these labels will actually tell you what the current intermediate line reading is. Remember, for those of you that are premium members who have access to these charts. This is chart 5A. Remember, you can always right-click on these miniature charts. So I'm right-clicking on the gold chart right now and then going to maximize sell. Not only will you see the label, which tells us what the intermediate line reading is, but you can actually see it with your own eyes down below. Because Thinkorswim is trying to save space, it's not necessarily allowing you to see it when we have our 12 grid view here. But if you wanted to zoom in, again, just right click, maximize sell. Here you can see, okay, well, on gold, it's 33.55 and rising, and that's what that looks like on the chart right there. You can see that, that green number off to the right-hand side telling us what the reading is on the green line itself. And that sometimes helps in a case like this, where you might be looking at this chart and saying, this doesn't look all that bullish to me. And I agree, by the way, I don't really think gold looks that bullish here either. This can help your eyes confirm that what's gone on here with the green line is it had been so oversold for so long that it was in this low reversal zone where even a little bit of a bounce like we've had here recently is enough to get that green line out of the low reversal zone. But I would look at this green line right now on gold as being more flat here in the last few days. And if this rolls over, it could easily go straight back to that dark green, dark pink background color. In other words, strongly bullish. Right now it's, or strongly bearish. So right now it's weakly bullish because the green line is not above 50 yet. And although technically it rose just a hair day over day, even though to the naked eye it looks flat, it did rise just a touch. As soon as tomorrow, if there was another big sell-off day in gold, you would be back to that dark pink background color, strongly bearish. This is not a great looking chart yet, despite having some signs of life from a posture perspective. Now, speaking of gold, one of the things that drives it is the U.S. dollar. U.S. dollar had a monstrous day today. Or sometimes when the markets get a bit chaotic, markets seek safety. And people, have thought about different areas as so-called safe. The U.S. dollar could be considered one of those areas. U.S. dollar compared to other currencies around the world is typically considered safe. Now, we can have a debate, a healthy debate, as to whether that's actually the case, but that's the way that the financial markets tend to perceive things. And so money did flood back into the U.S. dollar here today. That's a big move in UUP right there. That did pressure commodities. You'll notice gold was down 0.73%. Crude oil really took a gut punch there, down 5.6%. This has been a really nasty turnover rate here in oil, and that is a change of temperature for oil. prior to this last week, things were still pretty rosy for oil. Seemed like every time we had a little bit of a pullback, it would get bought. There does seem to be a bit of a different feel to what has just happened here in oil. So we got to be more careful here. In fact, some of you that are on Telegram would have seen we were stopped out of a couple of our oil trades here earlier today, unfortunately. And that's just the way the cookie crumbles. Remember, we'll never be perfect. We'll do our best. We'll learn from our mistakes. But this is a situation where, unfortunately, that strong dollar was just too much, and that oil chart is now starting to break down. So you got to be a little bit more cautious around oil than you might have been a few weeks back. So we'll see where this takes us. U.S. dollar is now at its highest level since March 8th. That was the only other time in the last 3 months where it was higher than where it is right now. So if we get a continued surge in the U.S. dollar throughout the rest of this week, it's entirely possible gold rolls over. We then get a strongly bearish posture on gold, and we continue to have our concerns there with oil trading below its moving average for the first time in many months. You notice that, right? Late last week, it fell below the moving average, popped back above there for one day, and now we're right back below it. So that's a different type of behavior than what we've had out of oil for the last 3 months. So we want to sit up and pay attention to that, respect the fact that, hey, things are changing here, and we're going to have to do our best to adjust in that case. Remember, another thing that the U.S. dollar can affect is foreign assets. Notice here that the U.S. dollar being up dramatically today tends to mean that foreign stocks underperform U.S. stocks. And that is what we experienced. Notice that EFA, which is the foreign stocks developed, was down 1.39%, easily underperforming the S&P 500. And then same thing can be said there with the foreign emerging stocks. They were down 1.91% and easily underperforming the S&P 500. Now remember, similar to the Nasdaq, for those of you that have been watching this video from me, and I'm sure David's been saying it as well for the last several weeks, EEM is a concern for me, and it has been. It's not like today is the first day I'm concerned about EEM. Some of you saw me tweeting about it a couple weeks back. It remains a concern. And the reason for that is it's similar to the Nasdaq in that its temperature changed in the first week of March, end of February, beginning of March. This thing went straight through its moving average. Its moving average started to give us that red coloring, telling us that price is below the 30-day moving average, and it never really gave us the mindset that it wanted to change, right? Over here, you had this big pullback. It bounced up and off of it. This time, it cut that moving average so deeply that every bit of energy it had to give you a reversion to the mean type of a move was still not enough to establish a new trading range above the moving average. So I am right now, I continue to think of EEM the same way that I think of the Nasdaq. They are both kind of more speculative, risk-seeking assets that are struggling in this market that is looking for more perceived safety. So you got to be a little bit more cautious there with EEM. Real quick here now on the sectors. So the sectors, we're seeing a little bit more wear and tear. Wanted to point out energy. Energy did slip in real time. Energy was at the top of our sector selector rankings last week, but if you go to chart 1E, if you're a Market Scholars premium member, you can see that energy has now lost that top ranking to another sector. So we'll talk about that in Monday in class. But anyway, did want to point out today that energy did fall below its 30-day moving average. The moving average itself is still rising, so that's why it's not red, it's yellow. Rising moving average combined with price below that rising moving average. So maybe there's a little bit of hope that you can find, some sort of support here and get back above it in the next week or so, but you do have to be more cautious around those oil names right now. I did notice that, your Chevrons and your Exxons seem to be holding up a little bit better today compared to kind of your mid-tier and small-tier oil and gas companies. So maybe that helped this particular chart at this moment, but still not a great look there to energy all of a sudden after doing so well for so many months. You have a weekly bearish posture there on energy. You also had a poor day out of the financials. Financials are sitting right on their moving average. They were down 1.4% today, but you're kind of hoping that they find support right on that moving average and get a bounce as soon as tomorrow. So, not all is lost quite yet with those financials. In terms of areas that did well today, There you seek that information out on the bottom rung. Again, these are your more defensive, non-cyclical areas. Notice that the three that were up today are all in that bottom rung. You have the consumer staples that were up 0.42% today. You had the utilities that were up 1.49% today. And you had real estate that was up 0.31% today. Those were the areas money was drifting towards today and kind of moving away from more of the cyclical areas. Utilities did the best, up 1.5% there. However, their background color remains kind of that light pink, meaning that we have a weekly bearish posture at this moment in time. Whereas we've got a little bit more strength out of particularly real estate, and I did point that out last week as well. This was an impressive breakout there in real estate when we got over that prior resistance area. We remain in a pretty healthy moment in time here with real estate. Staples, maybe not quite as consistent, but kind of making that move here recently with those stocks like your Kimberly-Clarks. And, and by the way, we did that bullish trade on Kimberly-Clark here a few weeks back. That seems to be doing well for us, that sold put trade. Walmart's a staple, Coca-Cola, Pepsi, Procter & Gamble, Clorox, Colgate, all those companies that I rattled off previously, they did well today. They were up, and that helped support consumer staples in general here today. One area that is struggling today is consumer discretionary. It was down a little bit more than the S&P 500 in general. It was down about 1% here today. You can see consumer staples did slip below that falling moving average here today. So the consumer discretionary area there now has that red moving average. And so that is telling us price is now below that falling moving average. And of course, that pink background color tells us that we have a weekly bearish posture as well. So that kind of leads me into the segue today for our trade application example. It's a very popular company, one that is kind of a little bit of either hot or cold, depending upon your mindset of the company. I'll explain here in just a minute. Let me pull up chart 4A for this. And the stock in question is Tesla. And this stock has been a widowmaker in terms of people who have wanted to go bearish on it in the past. So I have to be mindful of that and respect that. There has been a lot of people that have attempted to take bearish trades on Tesla, and more often than not, they end up getting a little bit of a bad taste in their mouth from that. So in this case, I am going to do a bearish trade on Tesla. However, I'm going to do it in a way where I have defined risk, right? The people who end up suffering the most on their bearish trades on Tesla are the folks that are just shorting the stock outright with no risk management technique that they are using. In other words, no stop losses or anything like that, and they've watched a stock go up 1,000% in the last couple of years. In this case, I'm doing what's known as a bear call spread. And a reminder that all of you that are premium members of Market Scholars, you would have already received the trade information while the stock market was open on our Telegram app earlier today, as I try to get that done, in the last half an hour or so of the market. So that way it gives you guys an opportunity to take the trades if you want to before the next day. Whereas everybody who watches the free YouTube video, they're going to have to wait until the next day to take the trade. Anyway, with Tesla here, you can see that it has kind of changed shape, obviously a big part of the Nasdaq composite. And so no surprise that it looks somewhat similar to the Nasdaq composite, where you had this kind of change of behavior that took place here kind of mid to late February. In fact, I think it led the Nasdaq a little bit from that regard to the downside. I think the Nasdaq itself, let me just check to make sure I'm not giving you the wrong information. The Nasdaq really kind of started breaching its moving average here later in February, about February 22nd. Tesla actually started breaching its moving average on February 10th. So it did it a little bit earlier. In other words, it was kind of a leader to the downside, a laggard, as it were, from a relative perspective. And so this is one that has been seeing some bearishness here more recently. I do know there were a lot of chatter out there on Twitter over the weekend. I know Cathie Wood and ARK Invest put out their new price targets on Tesla, and a lot of people were debating back and forth as to whether the analysts knew what they were talking about, and a lot of controversy around the insurance aspect of their business that they are anticipating, et cetera, et cetera. I'll leave other people to fight on those points. What I'm seeing here from a charting perspective is a stock that has a broken chart. It is one where clearly there were plenty of levels of support that were broken within the last 2 months. We had such a ugly sell-off where we got to the point of having what's known as oversold cluster signals, those 3 green dots showing up down below when our 3 colored lines on the market forecast go below that lower reversal zone. What that's telling us is that this stock may be a little bit oversold and due for some sort of a reversion to the mean type of a bounce, and that's exactly what we got. But like so many other charts, this one kind of had a whimper. This one moves around with a lot more aggressiveness naturally, but even that didn't even allow it to touch its moving average during that bounce after its clusters right there. We went up pretty significantly there on March 9th, but really, since March 9th, we've effectively just gone sideways. And now it's kind of giving you the impression that it wants to roll over again here. Notice that the background color went to pink here a couple of days ago when you're using that green moving, or that green market forecast line telling us that we still have a strongly bearish posture on Tesla according to the market forecast technical indicator. So what I ended up doing here is selling a bear call spread. I can't remember the exact strikes here at this moment in time, but I know it was well above this moving average, probably up here around 750 or thereabouts. And I think it was actually the April contracts. I did that a little bit different because normally with kind of lower implied volatility stocks, you're kind of forced to go out to like May at this point if you want to get decent return on risk. In the case of Tesla, because it's such a wild and volatile stock with high implied volatility, I was actually able to do the April monthly contracts in this case. So as long as we stay somewhat weak in the next 20 or 30 days and we stay kind of below $750, we would make money on that particular trade. And you can also see that the market sentiment line, we don't talk about this quite as much, but this dotted orange line on the chart has now fallen out of the upper reversal zone as well. For a long time, you could have said that Tesla had long-term bullish posture. Now you can actually make the claim that the bullish or the long-term posture using that market sentiment dotted line is also considered bearish at this point. So, as I mentioned before, you got to be a little bit more careful with Tesla. This thing can break your heart very, very quickly once you decide to get bearish on it. But right now, the charts are suggesting you'd be wiser to be on the bearish side of the coin than the bullish side of the coin. So that's what I had for you here tonight. Hope you enjoyed the presentation. If you did, one simple ask out of you, simply go over to Twitter, click like for us there. Remember, you can also do that while you're watching the video either on YouTube by going down into the description area where you'll find our Twitter link, and then you'll also be able to do it while you're watching it directly on our website where we have our little Twitter widget directly below the video there as well. So however you opt to do that, we certainly appreciate that. As far as I know, David should be back with you tomorrow, and then I'll be back in the saddle on Thursday. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.